Okay, equity is in a difficult space, so let's just divert for some time and see if there are other avenues for you to invest your money in apart from equities. Harshvardhan Roongta, Roongta Securities now joins us. Hi Harsh, thanks so much for joining us. Straight away, let me go across to our first caller. Anuj has called us from Bangalore. Hi Anuj.
Hi, good afternoon.
Good afternoon.
What I'd like to know is what would be the best fixed income investment instrument to balance my equity portfolio?
Okay. Harsh, what would you recommend?
Well, Anuj, currently if you see the high interest rate scenario, this probably seems to be the best time to park your funds into fixed interest instruments. Now, there are a couple of options available. Now, let me just enlist them to you. One option, if you are in the highest tax bracket and require tax-free income, and you want to invest in a lump sum, I would suggest look at tax-free bonds. There are listed bonds which are available, or else you will see new issues coming in the month of December, which is NTPC. The AAA rated papers with an interest rate of 8.5 to 8.9% for a 10 to 20 year period. So depending on whatever is the actual requirement, you can invest into these. Else you have non-convertible debentures, which are again listed. They're secured in nature. They have AA ratings. You can choose between the papers which are available, or look at bank FDs which are 9% taxable. Now the idea is that if in case you wish to invest into regularly, these are the options that are available in case you want to invest in a lump sum. In case you wish to invest on a regular basis, then PPF is one of the good options where you can diversify and invest some money into quality debt, which is offering about 8.7% right now. In case you have a short-term horizon, which is just 1 or 2 years in mind, then you can look at mutual funds. You can have short-term income funds or long-term income funds or dynamic bond funds. Now these will help you park your money for a period of up to 1 to 2 years. So these are all the options available in case you want to park some money into debt and diversify away from equity investments.
All right, thanks.
Just one, follow-up question. Now, just in case, adding to what Anuj has already asked. Now, if his time horizon is say 1 to 2 years, you said one of the options is
these short-term funds. Yeah.
These short-term funds. What would be the return that he would expect on that if he is in the highest tax bracket? Because the other option is you put it in a bank FD, which is taxed, and you get a 9% return.
Well, Rima, in bank FDs, of course, it is a fixed rate that you get and which is taxable in nature. In mutual funds, there are no fixed returns which have been announced or guaranteed to you at the beginning. So these are floating in nature. Whatever has been the market performance is what you're going to get at the end of the period. So assuming that the interest rates are at its peak currently, and we will see some kind of lowering of the interest rates in the coming quarters, there could be a possibility of a huge capital gains. But we cannot quantify that because it's subjective and it's dependent on market conditions. But however, considering that this is a scenario right now floating in nature, there is a possibility of a decent gains which could be double figure, it could be a double figure returns. Now there is a tax advantage as well. There is a tax arbitrage when you invest in a bank FD, you have a taxable income, wherein in case of mutual funds, because they are debt, the long term is treated as you get a indexation benefits. So there is a tax arbitrage in that context, and on the other hand, of course, you do not know what is the fixed rate of return that you're going to get.
All right. So Anuj, I hope you're listening in. That's some advice that's coming in for you. Just want to highlight a few lines that are coming out from JSW Steel. They have indicated, in fact, that they can go ahead and use that the INO that's available in Goa. Just to apprise our viewers, just a couple of years back, there was an INO mining ban that existed in Karnataka. They used to source the INO all the way from Chhattisgarh, that to an additional cost per ton of around 3,000, 3,500 per ton. So the very fact that they've come out and said these particular statements, remember there is some inventory lying in Goa, which is likely to be auctioned. So if they're interested in that one, that will be a bit of a boost to JSW Steel, because they're getting low quality iron and yet they're converting it into steel. But importantly, just watch out for Sesa Sterlite, because if in fact they have to sell this particular iron ore in the domestic market, they're going to get nearly half the realizations that they would get by exporting that. So those are the couple of stocks that you could watch out for. Sesa Sterlite, they could in fact also export it, but the very fact that JSW Steel has gone ahead and expressed themselves and said that they could use it. Interesting to see where this goes from here, because the Karnataka Steel Association had appealed that in fact they want to go ahead and they could use this Goa INO. But let's get back to some queries that we have gotten. We have received an SMS from Pooja Narayan, who writes to us from New Delhi. Pooja says she wants to invest in Reliance Mutual Fund debt monthly income scheme and wants to know if this is a wise investment or is there any better alternatives.
Well, Pooja, I'll just give you a very brief as to what a monthly income plan looks like. They're essentially debt-oriented hybrid schemes, wherein a large portion of money is invested into debt and a small portion into equities. Now, Reliance monthly income plan, for instance, has 80% into debt and 20% into equities. I'll give you another option, which is Birla monthly income plan. They have a portfolio of 85% into debt and 15 into equity. So depending on what kind of equity exposure do you want in your portfolio, you can choose between Reliance monthly income plan or the Birla. Now my only concern has been that in spite of the hike that we see in interest rates, the debt portion should be doing exceptionally well. Now which has not been the case. In the last 3 years, we've seen MIPs giving a return of about 6%. So in case you're investing a lump sum, I would suggest that you break that amount and manage it on your own. If you're investing 80 or 85% into debt, you have options which we've just discussed, the non-convertible debentures, the FDs or the tax-free bonds. Park that amount into a debt on your own, and you may choose a 10 to 15 to 20% into equities, again in a 100% equity fund. So this probably may be, you may be in a position to lock in at a high interest rate for the large portion, which is 80-85%, and the equity exposure you can take on your own again. So this may probably at the end of the period give you better return. In case you do not wish to manage both of these funds on your own, then you may choose between Reliance or Birla. Any one of the two are good, depending on whatever the equity exposure you wish to take.
All right, Harsh. Pooja, I hope you were listening in. Thanks so much for addressing both Anuj's and Pooja's query. Just wrapping up the show, but one quick update on the markets. It's been a difficult day of trade. We had a gap up opening, but thereafter things have only gotten worse.